if you need to.
Thanks. Okay, so again, what we're doing chapter 9, number 25. And the first thing I did was to get my dollar amounts, because it's easier for me if I've got those ready rather than having to do them at each. Does that make sense to you? Okay. And so when we have a sale, we're going to debit accounts receivable and credit sales. This is on September the 15th for this number, $40,000. But because the year end is the 30th, we need to, anything that is a monetary amount, which is accounts receivable, accounts payable, we need to revalue it. So we need to revalue the 40. It's a receivable, it's a debit. We need to revalue it to 42 with a $2,000 debit to accounts receivable. And that would be a foreign currency gain, a foreign exchange gain, whatever you want to call it. It's a gain. It does go on the income statement. And then when we receive the money, it's a bag of gold. It's not dollars. It's a bag of gold worth $37,000. We can do this in one entry or two entries. I'm going to do it in one. Receive a bag of gold worth $37,000. Take the bank and they put $37,000 into our account. We need to take the accounts receivable off. I'm skipping a line, which is up to $42,000. At that time, we need to plug it with a loss, a foreign currency loss. I'll let you write that down and get you to ask me some questions.
So you're saying that they reevaluated it on the 30th and it was a gain at that point in time, but then later on when they went to collect it, it was actually at a loss.
Correct.
Okay.
But the important thing here is that we actually did put the gain into the appropriate fiscal year.
Right.
So instead of just the 40 to the 37, which is a $3,000 loss, we actually had a 2 and a 5. Very classroom. I mean, for 30 days, not going to happen like this very often. It is a very good time right now to be traveling to Europe. The exchange rate is amazing with the euro. Just bought my Vatican tickets and it was 40 euros, which on my credit card was $43. It came out to $1.09.55. Amazing. I know, and no fee. Certain credit cards have no fee. Some of them have a 3% exchange fee. You always make sure if you're doing something like that. That's your personal tip of the day. Okay, so this was without any hedging. No option, no forward contract. That's very basic. You say, well, the journal entries that we do on the test, the journal entries, no forward contract, no options. Boy, I'm so easy. So we'll do another one though.
So you can just have two separate journal entries for the one on October 15th. You do loss and then accounts receivable and then
Yes, which is what they did up here. Okay, so you see what they did. They remeasured this to 37,000, and then they took the 42 off, which is fine. I just happened to do it in a complex entry and made it a little shorter. Either way, the results are the same. Any questions on that one? Let's do number, I'm sorry.
You'll generally have the two different accounts, the gain account and the loss account.
Correct. Let's, yes, you typically, or you have two gains or two losses, but in the classroom, you typically have a gain and a loss. Because they want you to make sure you understand that when it swings this way, you got a gain, and when it swings that way, you got a loss. So it could be two gains, it could be two losses. You know, it could have gone from 40 to 41 to 42.
Mm-hmm.
Then you'd have a 1,000 gain and a 1,000 gain, or it could have gone 40 to 39 to 37 or something like that. what's important is that you remeasure your accounts receivable, so I strongly urge the T account. So you see where it's going and how do you get there. This is what we had on the 15th. This is what we needed on the 30th. That's how we got there, with a $2,000 debit to accounts receivable. The resulting gain is the credit. If it's a credit, it's a gain, like revenue. If it's a debit, it's a loss, like an expense. Okay. Let's do number 26, which is the opposite. This is a purchase as opposed to a sale. We are the importer rather than the exporter. 25, we're the seller. 26, we're the buyer. It says on December 1st, 2015, Dresden purchases inventory from a foreign supplier for 60,000 LCUs. Okay, 60,000 local currency units. And it says they will pay in 90 days after it sells the merchandise. It makes sales rather quickly, pays the entire obligation on January 28, 2016. Currency exchange rates are, and they give you the 0.88. Remember that if you've got $1, you need to do 1 divided by this to get your number. Remember that? What you want is it to be in the position that we have in the book in number 25 and 26. We want it to be 1 local currency unit equals 88 cents. Okay? But if it's $1 equals 1.14 local currency units, just do 1 divided by 1.14, and that'll give you the 88 cents. Okay? So make sure you convert that on your test. So 88, 82, and 90, and you notice this is very classroom again. It went down, then it went up. So you're going to have one of them's going to be a gain, one's going to be a loss. Also, with the one that was 40, 42, and 37, there, and this was an accounts receivable, when the foreign currency strengthened and it cost us more, we had a gain, and then we had a loss, right? Remember that if this went from 40 down, we would have had a loss, the opposite. And also remember that when it's accounts payable, it's the opposite. We'd have to pay more. We have to pay 42 cents, this would be a loss. So accounts payable would have been a loss there and a gain there. All right, you understand that? All right, 88, 82, and 90, and those numbers are 52,
49, 2, and 54.
52, 8, why is this? 52, 8, I'm sorry, once again, 40,
49, 2,
thank you,
and 54.
54, thank you. So when we sell, rather than debiting accounts receivable, we'll credit accounts, or when we buy, we're going to credit accounts payable, either debit purchases or inventory. It doesn't tell us which one. It doesn't tell us whether we're periodic method, debit purchases, or whether we're perpetual method, debit inventory. It doesn't really matter. What I'm more concerned about is the gains and losses and the accounts payable. So I'm going to assume perpetual, debit inventory 52,800, and credit to accounts payable on the first day, which was December 1. When do we remeasure or revalue? At the end of the year and at settlement. End of year and settlement. Okay, good. So at the end of the year, if I do my little T account, this is accounts payable, it's got a credit balance. It went from 52.8 to 49.2, which means we need to debit this 3,600. If I debit accounts payable, then I need a credit to offset it. A credit is a gain. we paid it on the 28th. I'll do it this time, Peyton, I'll do it this time with 2 entries, like they did in the book, okay? We remeasure then to 54,000. So we need 4,800 to make that balance. Everybody following okay? I'm looking at your eyes. Okay, so I need to credit accounts payable, skip the line, credit accounts payable 4,800, and the debit then would be a loss. So in this year, the 2015 year, we have a gain. If they asked you what's the effect on 2015, it's a gain. If we had to do the sale, not only would it be the gain or loss, but it would also be the sale and any cost of goods sold if they asked you for that. And then the loss would be 4,800. So in the second year, we have a loss. Crossing them off as I do them. Great.
If we were to do this on the test, could we do the last entry and 1 entry as
You may.
opposed to?
I'm smart enough, I can do that. And you get full credit either way. And that's probably what I would do, because I'm just kind of, and I didn't do that all the way, did I? 128, I'd also, I need to, I need to accounts payable 54,000 and credit cash. That would be my 2 entries. My 1 entry would be debit loss 4,800, debit accounts payable 49,200, credit cash 54,000. Either way. And don't count on your test scores being up before Monday, because we are out of town with my dad Sunday, and we're gonna squeak in hopefully by midnight, and then I'm gonna come up here early Monday morning and get the test from Selena and grade it. So I gotta have your grades in by Monday at noon. Yeah, I know. So that's what I'll be doing Monday morning.
So you'll be like extra nice on us when grading.
Extra nice, of course. Am I not always extra nice? Okay, what else do we need to do here? Compute the foreign exchange gain or loss. Let me do that. I'm looking at the ones that were assigned. Let's do write this down. We may come back to 31, but we're going to do 33 right now. Did I do 33? I did 31 and 33. I'd look at those again because they ask you the first, in 31, the first one is a cash flow hedge. And it says, what is the impact on the first year's income? What is the impact on the second year's income? What is the impact on net income over both periods, which would net the 2? This part B of 31 is a fair value hedge. So you didn't do the journal entries. The journal entries you'll be doing are the very basic journal entries, okay? But you will need to know how to compute the gains and losses and what goes to AOCI and those kind of things, like number 31. And then number 33 is, it's a foreign currency option instead of a forward contract. So you've got 31 forward contract with cash flow hedge, forward contract with fair value hedge. Number 33, you've got foreign currency option, cash flow hedge, and foreign currency option, fair value hedge. And you need to know, you need to be able to compute the foreign exchange gain or loss. You need to be able to compute the forward contract amount. You know, what is the, so I would do a T account for the forward contract. Let me show you what those would be for each of those, even though I've already done this for you. Here's the forward contract in number 31A. You'll see in the solutions manual, the forward contract is recorded at $839.40. So that would be the answer if I asked you for that, the forward contract on that day. The forward contract then gets debited for $2,800, and let's see. two, the difference between the two. For 2,800 minus the 839. Impact, they don't really give you what is the forward contract on that. You know, they don't ask you for that. But that is something I may ask you for. Just net those two amounts. So you kind of need to know how to do the journal entries to be able to do those two. I do not remember whether that was a multiple choice. You know in your review sheet whether that's a
Yeah.
multiple choice. So you got a pretty good, you got a 1 out of 5 guess. There's A, B, C, D, E. For part B, and that is the impact on income for each year is given to you there. Okay, so forward contract, 1/12/31, forward. And remember that the forward contract is not recorded on the day of transaction. There's no forward contract on 12/1. Okay, the option has to be recorded because you pay for it. You have an outlay of cash for the option. Okay, and then you amortize that. So hopefully you got that. Part B is what if it is a fair value hedge with a forward contract. You still don't record any forward contract until December 1st. You do record it on December 31st, and that is at $839.40 is $1,960.60. And you've got that, you'll notice there's no AOCI here, no other comprehensive income. So you kind of hope that it'll be a fair value hedge and not a cash flow hedge, because it's easier. Okay. Part B, you remeasure the forward contract. The 2,800 comes in again, and so you take it off the books, and so hopefully you can go through that and get the answers that you would need for those two multiple choice. Okay. Compute translation adjustment. Let me find a translation adjustment one. Journal entries, journal entries, journal entries. Yeah, translation adjustment. Actually, that would probably be, it is. Okay, just ta-da. Okay. First of all, as I have encouraged you on the one-page outline, page 49091 is a comprehensive illustration. It does it does compute the remeasurement gain or loss, and it also computes, part B is the translation, it computes the translation adjustment at the very bottom of 493.
Which problem did you say?
The comprehensive illustration on pages 490 to 494 will show you how to compute a remeasurement gain or loss. And also, it does it the first time, what if we're remeasuring? The second time, what if we're translating? Okay? And so, and they do the trial balance. They give you the trial balance. And then they ask you to do a remeasurement computation, remeasurement gain or loss. And they also ask you to do the translation gain or loss, if you translate it, which is the bottom of 493, cumulative translation adjustment, 2006-16-60. So that's a very good one to work through. Do I need to work through that with you? Can you do that on your own? Okay. I think they've done it extremely well. They also show you how to do it in a shorter way. Actually, 16 translation adjustment for the cumulative, the balance is 26-16-60, but the adjustment, notice on page 494, I might ask you for the cumulative adjustment, which would be 26-16-60. Or I might ask you for the translation adjustment for the year, which is 64-76-60. Do you see the difference That's the amount by which it changed, and they did that computation of the change in the middle of 494, the upper part of 494. And remember that we have a remeasurement gain or loss or a translation gain or loss simply because not every number is being multiplied by the exact same foreign currency spot rate. Some of them end of year, some of them historical, some of them average for the year, which is historical. Right? That's why. Are you getting this back? Remembering when we first talked about this? I know it was the second day of class. I think it sunk in with my husband last night when I said, you know, I have 8 Saturdays in the fall that I'll be teaching. He went, 8? In one semester? I said, yes, sir. Oh. So anyway, and then 8, and you're teaching both semesters, so that's 16? Yes, sir. So, but for you, that's a very good thing. For me, it's fine. For him, he'll get over it. All right, what else do we need to do in that? An income statement for foreign currency. Let's do one of those. Okay. I think we may have done number 21 in class, because that was a shorty. What did I record for you? 23? Didn't do a video of jump return. You had assigned to you 23 and 29 and 30, I believe. And maybe 32. So let me find it. Number 24, where's that ask you for? The translation adjustment, the remeasurement gain or loss. Why don't we do that? Even though you've got a comprehensive illustration, let's just do one. We got the time? Right? Okay. So bottom of 499 on December 18th, 2015. Let me get the right chapter up here, please. On December 15th, 18th, 2015, Stephanie acquired 100% of a Swiss company, 4 million Swiss francs, indicative of book and fair value. The exchange rate was 1-to-1. On that day, the book and fair values of the assets and liabilities were as follows. They prepare consolidated financial statements on December 31st. By that date, the Swiss franc is appreciated to $1.10. Because of the year-end holidays, no transactions took place before consolidation. So there was nothing, so the only thing we're worried about is things that have to use the end of year or the spot rate on the balance sheet date. Those are the only things that would have affected our remeasurement or translation. So it says, determine the translation adjustment, and then B says determine the remeasurement. So if we're having to remeasure, remember when we do that, sorry, there's one more that might come on too, Craig, right above your head. Anyway, remembering that, that one illustration that's so good. On page 463, Exhibit 10-1, 10.1, temporal method, which is the remeasurement, right? The T's don't go together. Temporal and translation don't go together, so temporal is remeasurement, and current is the translation, right? That's how we remember that, okay? T's don't go together. And the balance sheet, so in the first one here, when we're doing the translation adjustment, we're looking at the current rate method on page 463, and the only thing that would be different would be stockholders' equity, additional paid in capital, and the dividends. We don't have any revenues or expenses, so everything else is at the current rate. So it's our net assets changed. The net assets didn't change. Assets minus liabilities in the foreign currency is still the same. So did anything change? No, I'm 24. Didn't require. So what they've done then, the easiest way to do this, I think, is actually we could use this as a balance sheet if I asked you, because I do ask you to do, no, I asked you to do an income statement. This is only balance sheet. So I'm not gonna spend the time to go through this, although you're welcome to look at it. But everything is at, December 31st spot rate except the equity, right? But what you really want to do is these two pieces. When you're computing the translation adjustment, when you're computing the remeasurement gain or loss, it's those two pieces. Because the only thing that is changing in a translation is the equity. Okay, remember this, right? That's called net assets, that's called net assets. And since all of these are at the end of your spot rate, that's the only thing that we have to look at. We look at it historically, then we look at the spot rate number. And that's what they've done. The net assets is the assets minus the liabilities. You do have that up there. The assets were 6.1 million. The liabilities are 2.1 million. So the equity is 4 million. That's net assets, it's assets minus liabilities, it's book value in foreign currency. Okay? Are we good? You remember doing this a little bit, kind of? Okay, so the first thing we do, and I will write it so that, even though it's up there, I'm going to write it so you can see it done one little step at a time, because you're going to have to do this. Beginning net assets, 4 million, local foreign currency units, foreign currency and rate and dollar amount, okay? And so beginning net assets were, should I move that over? There was no change in the net assets, thank you.
You can't really see the writing on the board as well
Okay, thank you.
from back there, so that'll
Thanks,
probably
Paul.
be better.
Okay, beginning net assets, it didn't change, so ending net assets. If we had changes, if we'd had a dividend, if we had net income, all we're looking at is changes here. We had an issuance of stock, a purchase of treasury stock, a reissuance of treasury stock. That's all we're looking at in the translation adjustment. Changes in those things. Doesn't matter that the assets changed, doesn't matter that the liabilities changed. What was the impact on the equity? Okay? So we don't have any, so we have an ending net assets. But if we did, we would multiply them by their particular rate and get a dollar amount. And then we would subtotal as these numbers. The rate there was 1 to 1. And so that is $4 million. 1 to 1, 1.00, $4 million. At the end of the year, ending net assets, you could say ending net assets, and then at historical, which would be this, if there had been changes, and then ending net assets at end of year rate, the rate, the 110. And so we want to compare this 4 million of local currency units to this, which is $4.4 million then that gives you the translation adjustment. The difference between those two is $400,000. Your net assets have increased in value, and therefore you have a positive translation adjustment, right? Your net assets have increased. That's a good thing. Historically, it would be this, but it is this at the end of the year rate. Therefore, it is a good thing, a positive translation adjustment. Any questions on that? Because there weren't any changes in that, let me look back on page 494, just to make sure you understand how to do this dot, dot, dot I've got right here. Okay? See how they started with net assets on the beginning of the year, 115. The only thing that changed in equity was net income and dividends, which are typical, right? Those are the things that change in your stockholders' equity section, and they multiplied it by the rate at which they happened, past tense, so that they got the end of the year, which for us was the same number, but they got a different number, $398,820, and then a dollar amount as the subtotal of that, and you would compare that to the $398,820 again, times the end of the year stock rate. So if there had been changes, 494 is a better computation for you. Any questions about that? Okay. All right, what about the remeasurement? Well, the remeasurement is the non-monetaries, which includes the equities, but it also includes other things. The remeasurement gain or loss, right? Back on that 10.1 on page 470, whatever that was, or whatever. I don't remember. I'm finding it. 463, thank you. Okay, the remeasurement method, the temporal method, also called remeasurement. That first column, well, your monetary things, the things that will settle in foreign currency, cash, marketable securities, inventory at market, which is unusual, your current liabilities, your long-term liabilities, other than your deferred tax asset or deferred tax liability, those things, as well as your stockholders' equity, are all at historical. So instead of net assets, it's net monetary assets. Net monetary assets. Well, so the remeasurement here, your monetary assets are cash and inventory is not at market, is it? I don't think it is. So cash of 800,000. There's no accounts receivable. They did include 1.3 fixed asset notes payable. $800,000 less. Oh, it is okay. The inventory doesn't say it's at market. Therefore, the only two monetary thingies you have are cash, 800, which is an asset, and notes payable, which was 2,100,000. So you have a net monetary liability. You're exposed in the liability way, not the asset way. You had a positive net assets for translation. You have a negative net monetary. So you have a net monetary liability. Your liabilities exceed, your monetary liabilities exceed your monetary assets by 1.3 million. So you start with a negative net monetary liability. If it had been positive, it would have been a net monetary asset. If you had accounts receivable, it might have been, and you had a small notes payable, it might have been a positive number. Okay. What you want to do here is all the changes for the net monetaries, for your cash, for your receivables, for your notes payable, for your liabilities. And so a lot of times, and we go back to 490, 490, like that, 2. We don't have any changes, but if we had had changes, they do it in, they use the net monetary assets, so they use the equity and the non-monetary. So what changed in your plant equipment? What changed in your all your stockholders' equity, common stock, APIC, retained earnings. So here on page 492, the net monetary, and this is the net monetary liability balance. beginning of the year. And then you would do the dots would be, here they were, our operations, net income. Okay. They bought a truck. That was a change in a non-monetary asset. You bought land, you sold land, you bought inventory. Actually, inventory is already there in cost of goods sold, so you don't have to worry about that. So they only had a couple of things here to give you an end of year net monetary asset or liability. Well, in this case, in this problem, number 24, is the same. Nothing has happened. We've had no operations. We've bought no trucks. Okay? Inventory hasn't changed in value, those kind of things. Okay.
So you're saying on the test we will have.
I don't remember, and I just gave it to Selena, so I don't remember, but it's possible because the one in the book is very, very simple. You don't have any changes, but you could very easily have some changes. So I want to give you both sides. Okay. I'm not going to give you the problem, as much as you would love for me to. Okay. And so we would start then with beginning net monetary liability times the 1.00 to 1 is negative 1.300 million. And then we'd have some other numbers to get an end of the year, which in this case is 1.300 million, but it's a subtotal here. You know, you bought a truck, the historical rate of the truck, put that there. And that would be net monetary asset going up. Okay? Truck goes up, that'd be a positive. Paid off a liability, that'd be a negative. Okay. So your operations were positive here on page 492. Purchase the truck, negative. So, okay, so we've got, because your monetaries are going, net monetaries going down. Okay. And then we compare that to ending net monetary, which is the same always, no matter whether you did anything here or not. This is always the same number. And it's times, this is not times anything. This is a total here. Okay. Times 1.10, and you get 1430. And that's $130,000. It has changed so that our net monetary liabilities have increased, which is a remeasurement loss. It's bad. We have more monetary liabilities than we have monetary assets, and we have more. We have even more monetary liabilities relative to our monetary assets at the end of the year than we did at the beginning of the year.
So you're saying that end of year net monetary liability after we calculated changes is
That number is that number.
Okay.
You put it there again. And you multiply it by the spot rate at the end of the year. And you want to compare your subtotal here to that computation, and that's your translation or remeasurement gain or loss. Just as an aside, what this company might want to do is have some kind of an investment in the long term, you know, a marketable security that would increase their net assets, so it would better hedge the fact that they are having remeasurement losses. If they would spend some money and buy in that foreign currency some assets that will be on a different exchange with that same foreign currency, they could naturally hedge that. And any gains on one would be lost on the other, and it would offset. You know, just FYI. But this is a loss because our net monetary liabilities increased. If net monetary assets increase, that's a gain. If our net monetary liabilities decrease, that's a gain. You got it? You're with me? Everybody following? You're going to sleep on me. What time did y'all get here for Selena? 9? Okay. Okay, so I did those. Let's do an income statement for foreign currency. And you do one of those. Where? Do you see one that I can do? Number 26. Prepare an income statement, statement of retained earnings, and balance sheet. I can do all three for you if you would like. But since you don't have it on your test, do you really want me to?
No.
Okay. I don't really want to either. Okay, and then 27 is the statement of cash flows. We won't do that one either. So let's start on page 500. Number 26, Fenwick Company organized and began, actually I'm gonna stop the recording. It's easier to chunk it. And I'm gonna do it again, okay? So we've been going for a good long